This is the Build Wealth Canada podcast, episode number 67.
Welcome to the Build Wealth Canada podcast, where it's all about becoming debt-free, accelerating your wealth, and taking control of your money. Now, here's your host, Cornell Schreiber.
Hello and welcome to the Build Wealth Canada show. Today, we're going to cover two main subjects. The first will have to do with best practices when it comes to sticking to your investment plan. It's easy to do so when the markets are doing great and we're seeing double-digit returns like we did in 2019. But what about when we're experiencing things like a rapid 30% decline, which we've experienced in early 2020 due to COVID-19? So to help us discuss this, I have Brendan Wood on the show, who is one of the founders of Passiv, a Canadian fintech company that builds tools for DIY investors like myself. And I'm basically a huge user of their tools. So Brendan grew up in Newfoundland. He earned a master's degree in robotics and eventually switched to software engineering as a career. And Passiv, his company, started out as a personal app that Brendan used to manage his retirement investments and eventually evolved into a global investing service. So I really wanted to talk to Brendan about Passiv, as it's a tool that I use at least once a week to accurately track my investment portfolio and see how it's doing. It's a huge time saver for me, as it lets me see all my investments in one place instead of constantly having to add up the totals for each of my 7 accounts just to see how my portfolio is doing as a whole. So just to give you some context, in case you're new to this whole do-it-yourself investing, typically what happens is every person who's investing themselves is going to have typically 3 different accounts. You'll have your TFSA, you'll have your RRSP, and generally if those 2 are maxed out, you'll also have your taxable account, also called a non-registered account. So that's 3 accounts right there. If you have an RESP, so if you have kids, you should be investing in an RESP as well. So now you're up to 4 accounts. Now, if you have a partner also, then they will have 2 to 3 accounts themselves. So they'll have a TFSA, they'll have an RRSP, and they'll have a taxable account, also known as a non-registered account. So essentially, you're dealing with 7 different accounts. And so if I want to know how my investments are actually doing as a whole, I essentially have to log into my account, log into my wife's account, go into each account, add up all the totals in the spreadsheet just to get a total. So it's not fun. It's annoying. It's manual labor essentially that you have to do just to know, hey, how's my portfolio doing? How much cash do I have in my accounts? That those dividends got issued. How many dividends did I get? So it just becomes this really annoying thing. And so what I like about Passiv, and the reason why I've been using it now for quite some time, is because it's all integrated with Questrade, which is who I use. And so I basically get to see everything all at once by just logging into one account, which is my Passiv account, and I see everything and I get all the reporting and all of that. So I'm a huge nerd when it comes to efficiency. I love that stuff, and that's what Passiv does. So what's also really neat is that if you've taken my investing course, then you know that I supply spreadsheets that you can use to help automate the rebalancing of your portfolio. Well, what's neat about Passiv is that they actually automatically calculate how much you should buy of each of your investments to get back into balance. So you don't actually have to use a spreadsheet anymore for your rebalancing if you don't want. So I like to use it to basically double check all my work. So it's super helpful if you do like using spreadsheets too. And one of the big reasons that I wanted to have Passiv on the show again is that it's actually recently become available for free if you use Questrade. So they were always free for the basic account, but if you wanted some of these really cool premium features, you basically had to pay. But now you can get them all for free if you use Questrade, which is also, and Questrade is also free, and it's who I use and who I recommend anyway. So it's a pretty big event where you basically get access to all of this for free now, whereas you used to have to pay for it. So, at this point, it's basically a no-brainer to use. And it gives you the reporting and automation you don't get through Questrade. So it's pretty awesome in that regard. And in a way, it gives you a lot of that automation that you get through robo-advisors without having to pay the higher fees that robo-advisors charge. So, I'm definitely a big fan of that, especially now that you can get access to all the features for free. So if you want to check them out, I definitely encourage you to check them out. It's over at getpassiv.com. Passiv is spelled without the E at the end. Or if you're having trouble remembering that, you can just go to buildwealthcanada.ca/passive, and you can spell that with the E, without the E. That's just automatically going to forward you to getpassiv.com. And then to get those premium features for free, basically you just have to go to getpassiv.com, you sign up for the free account, and then you just follow the prompts to connect your Questrade account to Passiv, and then you just accept the upgrade offer and you're essentially done. Whereas if you're an existing Questrade user, just go to getpassive.com, you log in, you get a free account. And then if you see that you don't have all the premium features, just go to settings. And then in that subscription panel, you'll see a button where you can basically click to get the free upgrade. So that's it. So that's essentially how you get all the premium features for free now, as long as you're with Questrade. All right, and before we get into it, I also wanted to give a quick announcement that I've taken over the Canadian Financial Summit and I have free tickets for you. So the conference is 100% online, so you can view the talks from anywhere. It's specifically for Canadians. It's taking place in September, and I'm bringing on over 25 Canadian personal finance experts to share their best practices to help you retire early, invest better, lower your fees, pay less in taxes, and help you learn the best practices when it comes to personal finance and investing so that you can hit your financial independence number years earlier. That's really the main objective for me, is if you're able to quit your job or just do whatever you want because you've hit your financial independence number. If you're able to do that years earlier, then basically I've done my job with this conference. And so collectively, the guests have hosted over 600 podcasts. They've wrote over 20,000 blog posts. They've been featured in hundreds of media articles from major news and financial publications in Canada, such as the Globe and Mail, the Financial Post, Global News, CTV, Yahoo Finance, and many, many more. So because I'm running it, I get to give away free tickets to the entire event. And so to get them for free, when I release them, all you have to do is sign up anywhere on buildwealthcanada.ca. So that's just the main site, the main podcast site. So that's buildwealthcanada.ca. And that way, if you sign up there, I have your email and I can basically send the free tickets to you when I release them. And also as a bonus, when you sign up, you'll also immediately get my PDF guide on the other top personal finance and investing tools that I use in Canada. So it's all free, and all you have to do is sign up anywhere over on buildwealthcanada.ca. All right, so I look forward to seeing you there. And now let's get into the show. All right, Brendan, welcome to the show.
Thanks for having me, Cornell.
So, Brendan, I'm excited to share how I use Passive just because it saved me many, many hours at this point, and it makes checking up all my investments really convenient. But I'm curious to hear from you how others are using it. Selfishly, just in case maybe there's some cool feature that I don't even know about yet, because I really want to learn everything I can just in case I'm missing something. But yeah, everything I've been using so far has been fantastic. So, are there any features or use cases that you see being used most often by your users?
Well, I mean, the obvious one is, probably what you're using it for as well. It's like the headline feature is running your own balanced portfolio inside a brokerage account, right? That's what it was designed to do, and it was designed to do it with ETFs. It can do it with stocks as well, but most people, they focus on the ETFs because that gives them, the broad diversity that they're looking for in their assets. So that's clearly the number one use case, but there is a lot more to it than that, right? So one of the things that surprised us when we built Passive originally was that a lot of people actually had stock picks in their portfolios as well. So when we built it originally, it was like, well, people are just going to hold ETFs and they're going to follow the couch potato portfolio exactly, and they're not going to make speculative bets, and it's going to be very simple, And a few months after we had launched the product and we had a little bit of data on how people were using it, we found that people were actually picking stocks on the side. And it was a problem for our app because we built it around the assumption that they wouldn't be doing that. And so we were always saying, oh, well, you should just sell that stock pick because it's not a part of your target portfolio,
Right.
And yeah.
So you built it assuming that, or like for the ETF index investing purists like myself. And then, but the reality is that some people like to take that, from what I've seen, maybe 5% of their portfolio and just use that for speculative type investments, right?
Exactly, yeah. So we like to call that core and explore. So you have like your core portfolio of balanced ETFs and then a few speculative picks on the side. And that's fairly common. Probably about a third of passive users do something like that. And it was something that we had to kind of scramble to address in the early days because for that segment of users, passive just wasn't working for them at all. And so that was like a really interesting use case that we found. And so now we support that fully. You have the ability to exclude assets from your portfolio so that they don't get included in the calculations. We just pretend you don't have them and they can, you can put money in there and we ignore it.
Okay, that's great. Yeah, because if you're making a speculative bet on a stock, then you don't want passive always saying, hey, you're over or under your target, because you're just trying to hold that thing and hoping it goes up. You don't want it to totally affect your core strategy, right?
Yeah, exactly. It's kind of like a separate thing, right?
Yeah, yeah. I guess it can be useful because I know one practice I've heard is that you also don't want to have too much of your portfolio weight in any single stock. Like I think it was, if I remember correctly, 5% is kind of like the best practice that I've seen. And so if at least Passive, I guess, would tell you that, but you also don't want it always like bugging you every time that stock fluctuates, right?
Yeah, exactly.
Yeah. Okay, so go ahead. I cut you off.
Yeah, that's probably one of the most interesting things that we found. Like one of the first aha moments when we were building this is like, okay, people aren't all purists, and so you kind of have to account for that. In terms of the balanced ETF investing stuff, like that was kind of the original use case, and allowing people to exclude stocks is really just reinforcing that you're able to do this while doing your other thing on the side. That's fine, But really, the fast cash allocation and rebalancing is the core use case that people have for it. So people will log in, they check their account balance, they see if they have cash, and we make it really easy for them to apply that cash to their account. And so the default way of doing that is we buy the most underweight assets in your portfolio, which means that we're sort of like doing this continuous rebalancing thing that's always moving you closer to your target as best we can. And you only, I actually, as a passive user for years, I didn't have to do a full rebalance on my account up until this whole COVID disaster a couple months ago, right? And that was the first time when the markets went out of whack enough that I actually had to sell some things in order to rebalance.
And by full balance, you mean actually selling something and buying to rebalance,
exactly,
as opposed to just buying with new cash that you have from your job.
Yeah, that's right.
Gotcha. Yeah.
So one of the features that actually helps with that is drift notifications. So one of the metrics that we have in Passive is your portfolio accuracy, and that's kind of the most important thing you would want to pay attention to. So you set your target portfolio, and we compare it to your actual holdings and say, this is how accurate you are on a scale of 0 to 100%. So 100% being you're perfectly accurate, and there's really nothing for you to do. So you can set a threshold that says if your account accuracy drops below, say, 95%, we will detect that and fire off an email to let you know, hey, the markets have shifted and you've fallen below this threshold, which you set for yourself. You might want to log in and decide if you want to sell some things to rebalance or maybe just put more cash in to make up the difference.
For sure. Yeah, I really like that feature. I find it really useful. And usually I don't get those notifications because the portfolio doesn't drift so drastically. But with this whole COVID thing, I did have that trigger on my end. And I remember getting that notification from you guys saying like, hey, by the way, you're actually off your allocation now because of the craziness that's been happening. And I like that, right? Because it's like a push notification. So it's easy to forget when we're all busy to rebalance our portfolios. But this way, it's a reminder saying, hey, you're off. And I remember, actually taking that email and saying, okay, let's rethink this. Let's actually focus on this now because, I mean, it is a significant thing for managing your own portfolio 100%.
Yeah, definitely. In terms of other use cases people have, so on a smaller scale, people will do things like they'll group their accounts together to manage them more easily. So instead of, like if you have, say, a tax-free savings account and an RRSP, instead of managing them separately, in Passive you can merge them together as a single portfolio and set one target for both of them. And it kind of like manages them together and makes sure that as a whole, they meet that target. And so it just kind of gives you fewer things that you need to really worry about. So in my case, I have 6 accounts. And they're not all for the same purpose, so I kind of group them by purpose. There's like my kids' education account, and so that's one purpose with its own target, and that's a target that will adjust as we get closer to them needing the money. And then there's my retirement assets, which is pretty much everything else all grouped together. And so it makes it really, like I really just kind of have to pay attention to the 2 portfolios and act on that basis.
That's great. I'm smiling as you're saying this because I have my structure the exact same way. so I'm glad that I decided to structure things the same way that the lead developer of Passive is structuring his. So that's good. I'm glad I'm using it the same way you are. That's great. But that's right, because the RESP, so for your kids, that should be treated as its own separate portfolio because it has a totally different purpose and it has a very different use than your retirement portfolio. So you do want to treat those separately. And so I have it the exact same way where we have 7 accounts in total. So TFSA, RRSP, taxable account, both for my wife and I. So that's 6. And then plus the RESP, the family RESP. So so I have it the exact same way where all of everything for my wife and I, those 6 accounts are together, grouped as one. So I can just track it as one, which is great because I don't know any other software that lets you do that in that kind of way and that efficiently. And then the RESP is its own animal that you're basically managing. So yeah, it's great.
Exactly. Yeah, and you kind of touched on it there, but like linking accounts from family members and spouses as well is like, it's part of the same sort of thing, right? Where we're trying to make it easy to bring it all together as much as possible. So I have the same thing with my wife. She has her own RRSP and her own tax-free savings account, but I'm kind of the one managing the money, right? So they're just linked to the Passive dashboard, and it's seamless as far as I'm concerned. I don't need to log into her Questrade account in order to manage it separately, right? It's all part of the same thing.
Oh, that's huge. I mean, that's one of the things that got me totally hooked on you guys initially was because, and maybe someone that's totally new to all this, I feel like maybe they might not know how awesome this is, but just to give an actual example. So when you have, like, let's say you're with Questrade, like what myself and you use, and you want to check how your portfolio is doing holistically. So just for your spouse and for yourself, well, you need to log in to basically, so first I would log into my account. I would have to get the totals for each of my accounts. So RSP, TFSA, taxable. Then I would have to log out, go into my wife's, do the same thing, and then basically you add all the numbers up in the spreadsheet, and then okay, now you've got the grand total to see how your portfolio is doing. And then for myself, like I like to do really like the high security thing. So I have the dual authentication thing, right? Where you get texted the code on your phone in order to log in. So it's like you want that security. So I do that, but it makes it even more of a hassle to log into 2 accounts and add everything up. So the whole big thing with Passive is that you don't have to do that in terms of logging into both accounts and adding everything up. You basically log in, and right at the very top, it shows you that grand total right away. So, you hear about the markets dropping or rallying, what you want to see what kind of an impact that had on your portfolio. Well, it literally takes you seconds to pull up versus the old way, the way I used to do it. I mean, it's annoying, and you don't want to do it because you have to keep logging in and, manually adding things in a spreadsheet. So it's great. It makes things super convenient.
Yeah, for sure. One of the things you touched on there is like checking your portfolio value, right? And that's something that we've kind of like struggled with internally of like, how easy should we make it to watch your own performance, And the reason why we struggle with it is because in my opinion, it's kind of like antithetical to passive investing to pay too much attention to your performance, especially on like a day-to-day basis.
Right.
The whole idea is that, you're investing in a broadly diversified index that represents the market as a whole. And, your boat's going to rise along with everybody else's. So it doesn't really matter how things are going on a day-to-day basis. So should we make it too easy for people to see how they're doing things on a day-to-day basis?
Right.
And it sounds kind of strange to be like, well, maybe we don't want to tell people how they're doing. But the point is that it shouldn't really matter, right? But so having that value up at the top was kind of like one of the first things we sort of like compromised on and said, well, okay, we'll show people what their total account value is. We'll make it easy enough to see that, but maybe we don't want to make it too easy to drill down, and maybe we don't want like flashing green and red lights everywhere telling you whether you lost money on a daily basis,
Right.
Because it's not really relevant for a passive investor.
That's right.
But recently, we decided to release a performance reporting page, and this was kind of like a really big step for us where we're saying, well, this is we're doing something that we were kind of like shy about doing for a long time because it's sort of like borderline on the edge of like, is this something a passive investor should really be caring about?
I love that your reporting feature though. So I like, it's just fun to see all that.
Yeah, well, and I think we did a really good job of like designing it in a way that still meets the passive investing ethos, right?
Yeah.
So we started developing it probably around like December or January. And by the time we were ready to release it, it was right in the middle of the pandemic. And it was kind of funny because we started building it back in January thinking, cool, people will love to see how much money they're making and we can do it in a way where it's not obnoxious,
Yeah.
But then when it came time to release, we're like, oh man, as soon as we release this, everybody's just going to see their portfolios falling off a cliff. Is now really the right time to do it?
Yeah.
So we did it anyway, but we did it with, the focus of it is less about your portfolio performance and more about your own personal performance. And we kind of like break it down into like things you can control and things you can't control. So things you can control are like your contribution rate, like how frequently you're contributing, how much money you're putting in, are you doing this consistently, and so on. And so there's like the contributions view, which is like contributions versus withdrawals. And that is like the number one thing we show you when you come into your performance page. And then right up next to it is something we call the streak, which is the number of consecutive time periods that you've contributed to your account. So it's trying to encourage people to invest consistently over long periods of time and kind of build it into a habit of, paying themselves first. So that's the primary focus, is like, how are you doing at contributing to your accounts and managing the things you can control? Mm-hmm. And then the other side of it is, well, how well is your portfolio doing? And that's sort of secondary. It's down below below everything on the performance reporting page. But again, we show you, well, here's how your contributions have done over time in terms of like, here's your total contributions to date minus withdrawals. And then there's another graph on it, which is like, here is your investment performance over time, like how much money you've made on the whole from investment gains. And so we show you those two graphs so you can very clearly see a difference between what you're doing versus what the market's doing.
Mm-hmm. Yeah, I really like it. It's I was so impressed by it because, I've seen my share of reporting tools, but I like how it, to me, at least, I don't know if, I'm guessing this was intentional. It sounds like you guys talk, okay, what's all the things that people may want to know and what's truly important and what's the bottom line people want without overwhelming them with a million stats. And then you basically just pick the most kind of important, most useful, most relevant information to get a really good snapshot of how your portfolio is doing. And so I just think you guys did a great job on being so selective in picking and choosing what to show and what not to show. Because this is investments, right? You could create like a 50-page report of stats if you wanted to, you know what I mean?
Exactly. Yeah,
And then people get overwhelmed and it's like so much of this is not relevant, and now what, people are going to start speculating based on this, that, you know what I mean? And you don't want that. You're a passive index investor. So I just think you guys did a really, really great job. And I will say too, from if you're in the accumulation phase where you're still saving for your retirement, the things you mentioned are obviously very useful. But for myself, we're now in sort of that where we're actually living off our investments, and so I thought it was neat as well to see some of the information you have on there for dividends. So I could see, okay, it actually shows me, automatically calculates my average monthly dividends if it was all split on a monthly basis, and I can say, okay, all time, how much have I gotten in dividends, right? And so that, I find that's useful, right? Just from a cash flow management perspective. So, okay, I know typically I'm going to get around this much in dividends every 3 months. And then how much of my ETFs do I have to sell to make up any sort of shortfall, from what I want to spend? So it helps me, I found, as someone that's actually also living off their investments now, it was useful just for cash flow management purposes as well. And it's just super interesting, and it's really fun to be able to go to that all-time tab and say, okay, ever since I started investing, how much have I actually made in terms of capital gains and in terms of dividends? So that's a really fun thing to see, I find as well. As long as the markets didn't just tank 30%. Yeah. I wanted to mention that I think you guys did an awesome job on that. I'm a huge fan of it.
Oh, thanks. I appreciate it. Yeah. I'm pretty happy with how it turned out as well. Like, like I said, we were concerned about doing it and like doing it wrong. And I think we've kind of like struck the sweet spot, which is a nice balance.
Yeah. Yeah. I just love it because there's just, like I said, there's so many things you could show, and it's not one of those things where like the more you show, the better, because that's not necessarily the case with investing, right? Especially if you're a passive investor, you just want you want the bottom line, right? And that's what you guys did. Right. So, yeah. Is there anything else that you wanted to mention? I keep sorry if I keep interrupting. I'm just so I really like this tool, and you guys added all these features, especially the reporting, and so it's got me really excited. So I just keep jumping in, saying how much, telling you what I like.
That's like the main stuff, right? We actually make a conscious effort to keep the features relatively clean cut and to a minimum. One of the things that one of the reasons why we started Passive is because we found our brokerage dashboards just had way too much going on, and it made it very difficult to focus on, the task of how do I actually manage a balanced portfolio on a day-to-day basis. And so kind of the fewer things we have, the better, in my opinion. But some things are important, and we are kind of like exploring new things, but it's also it's always like tempered by, well, are we going to make the product worse on the whole by adding all these extra features, you know?
Yeah, I mean, if you want the nitty gritty, anybody can still go into their Questrade account and pretty much look up anything, and be as granular as you'd like. So everyone still has that option. But I find usually it's like, okay, I don't want to spend 2 hours adding up things in a spreadsheet. I want to just kind of get the bottom line, and I want to have it for both myself and my spouse, right? I find that's a big thing, because even when you look at that granular stuff in Questrade, that's only for one, it might be for only one of your accounts or for all of your accounts, but then what if you have a spouse? You have to now incorporate everything that they have too, right? So, so that definitely a big shortcut from what you guys did.
Yeah, for sure.
Yeah, and I don't know if I can't remember if I mentioned this already, but one of my favorite features is how you guys are so integrated with Questrade, and so I don't have to manually update the numbers whenever something new happens. I find that's just such a nice feature because I used to use Yahoo Finance, the app that they have, and I mean it's a great thing, and they have great tools there as well, but the problem is that, you have to pretty much remember to always manually update anytime you do something to your portfolio, whether you're buying or selling or reinvesting your dividends. And if you forget to do that, well, then now you're not looking at the most up-to-date data on your portfolio, which is obviously bad. So whereas with you guys, you actually basically sync with, you pull the data from Questrade, right? So you don't have to remember now to manually make changes, because anything that you actually did, it's automatically reflective in all the reporting you guys do. So I think that's pretty great.
Yeah, me too. That's like, it's almost something that I forget about, because it's something we've been doing for so long, right? But that's really one of the core features, is not having to do manual data entry. Not many people know this, but Passive actually started out as like a manual portfolio tracker thing. So back before it was called Passive, it was called Rebalancer, and it was like a really simple tool that would allow you to enter your current holdings and set a target, and we would do the calculations and tell you, here are the trades you need to make in order to follow that, right? And nobody used it. It was, it was probably in 2016 that I launched this, and it was posted around the internet several times, and people would come in and they would look at it, and they just wouldn't use it. And eventually I realized, well, it's because it's not really a quantum leap over a spreadsheet, right? Like, people, if you're already doing this kind of investing, you probably have a spreadsheet for it. And using an app instead of a spreadsheet to do the exact same thing is not really, it's not that much better. You still have to manually enter all of your assets, right?
Right.
So integrating it with Questrade's API to pull that information automatically is, the fundamental leap that made it super useful, in my opinion.
I mean, I think it's a huge differentiator for you guys, because, like you said, if someone's not, well, there's all these tools out there already that do that. So it's like, well, how do you differentiate yourself, right? That's the challenging thing. And like you said, most people already have a spreadsheet as well, and spreadsheets obviously have massive limitations. But what's great about them is that you have full control, right, over everything, which is great. So it's like, well, and then if you're like a spreadsheet lover like myself, it's hard to pull away from the spreadsheet. So it's like, there better be something really compelling to get me off my spreadsheet, or to get me to primarily use something else. And so in this case, though, I think the fact that you automatically, pull the data from Questrade is a huge thing, right? Because I mean, I want to do fun analysis in my spreadsheet. I don't want to do manual data entry. So
I don't know. That's boring.
So it's like, you can still use spreadsheets, and I still use my spreadsheets to do some analysis and things like that, just for for fun, and just like for cash flow management and all that. But I mean, that's the fun stuff, is the analysis. So you can still do that, but you don't have to do the data entry anymore. So no, so that's great. That's awesome. One of the things, so you talked about this a bit already, about how you will set notifications if you're off your allocation. So you basically set what allocation you want for your portfolio, and if the market shifts significantly enough, you guys will do that notification. I wanted to get your thoughts about when do you suggest people adjust their portfolio? Is there a certain percentage that you like to use? Like I use Larry Swedrow's approach, where he does the 5%. So if the portfolio adjusts by 5%, either up or down, that's the signal to rebalance. And then if you have a smaller holdings, like I have for emerging markets, I use 1.75 just for my personal stuff. So that's my approach. But what do you guys say? Like, what do you personally do? What do you suggest others use for that threshold?
Personally, I use 5% as well.
Okay.
And it's not that I'm like following anyone's particular advice on that. It's just that I find that's a good number for me. Um, like I was saying earlier, like over several years of using Passive, there was, the first time that I actually fell below my 95% threshold was with this pandemic, right? And so it basically means that I didn't have to do any selling to rebalance at any point because it was always on target. Now, I could have gone down to 90% if I wanted to, but if I had, then it wouldn't have triggered a rebalance during this pandemic, right? Which maybe that's not a bad thing, but basically I looked at my accounts and was like, well, if it's off 5%, that's enough to justify spending $5 or $10 on a couple of trades to bring it back into alignment,
Yeah, and interesting I mentioned that. So yeah, just for anybody that's maybe new to this, I mean, when it comes to rebalancing, sort of the traditional approach is that you sell whatever is now overweight and you buy whatever is underweight in your portfolio. And it's interesting that you said in your experience, this was the first time that you actually had to sell something in order to get back into balance, because before that you were just using whatever new money you had to invest to get back into balance. And I say it's interesting because I had the exact same experience. So when we were kind of approaching or trying to accumulate and both working full time and trying to get to our financial independence number, that's exactly basically how we would rebalance. I don't remember having to sell a single time because every time we got paid, every month, once a month, I would take whatever money we're going to invest that month and I would just allocate that money accordingly to get us to that correct balance. And so there was no selling necessary. So that makes things actually really nice and also affordable in Questrade, because with Questrade you can buy the ETFs for free, and so your costs are basically just bare bones at that point, which I found to be really, really useful. And I like how you guys, I noticed you have that feature in Passive as well, where you can say, okay, show me how much I have to buy and how much I have to sell of each one to get me back into balance. Or there's an option that you can click, and that's what I have, is you can Passive will tell you just, okay, here's how much, with the cash you have, here's how much you should buy of each ETF if you don't want to sell anything, and just to get you closer to that asset allocation that you want. So I find that was a really, really neat feature. And I got a listener question recently about that as well, saying, well, what if I don't want to sell anything? What if I just want to use my, new cash that I have, and you just use that to help me get closer to the balance that I want? So you guys basically have automated that, which is awesome.
Yep, exactly. And actually trying to figure out how to do that calculation was interesting because there's a lot of ways you could approach it, right? And it really turned out to be just like a really simple heuristic to get back into alignment. And it's basically like, look at the assets in the account, calculate how much underweight or overweight they are, and then sort them by how much underweight they are. So you basically do that quick calculation to find the most underweight asset, buy 1 unit of that asset, and then do the calculation again, right? And after you buy that 1 unit of that asset, maybe it's no longer the most underweight, and so you need to buy a different one, right?
Yeah.
But it's just like kind of a really quick iterative calculation that continually buys the most underweight asset until there's no cash left. And at that point, we say, cool, here are the total number of units that we need to buy, and that's the order. So it's really pretty simple and elegant, and it works well.
Yeah, I like how you guys automated it, because I have an investing course, and when I got that question from one of the course users, I basically created a spreadsheet that let them do that as well, and it works and it's great, but it's still a spreadsheet, so you still have to actually enter the numbers in order for it to tell you what to do. So I like how with you guys, it's just you don't have to use a spreadsheet at all, basically. So that's fantastic. Yeah, it's great. I still use both just to stay sharp, and so I still remember how all the math works and all that kind of stuff.
Absolutely.
So I use Passive kind of to double check my work and make sure it's all is good, and just to stay on top of it still. Because I'm like, automation's awesome, but for someone like myself who's in this field, I'm like, I also want to always know exactly how those calculations work too, right? So
exactly. Yeah.
But
there's a trust thing too, right? Like if you're relying solely on us, then you're kind of like trusting that we do it right.
That's right.
That we're making the right choices,
Yeah, for sure. Yeah, and I remember, when I initially started using you guys, I basically compared what you guys suggested to get me back into balance to my spreadsheet that I have as part of the course. So I do use that spreadsheet myself, and I said, okay, am I recommending the same thing that they're recommending and vice versa based on these inputs, based on the math. And it was consistent across the board. So I was like, okay, sweet. Like, we're both doing our math the same way. Everything looks good. And you guys just have an automated way of doing it where it pulls that info directly from Questrade and automatically does it for you. And then the spread, I still think the spreadsheet's, once again, useful because you do want to still understand the logic behind how it's calculated. I think that there's some value in that, right? Just like in
absolutely,
just like if you're learning math in school, you want to know how to actually like add things.
You want to do it with a pencil first, right?
Yeah. Like learn how to actually add instead of, well, the answer is you put this in a calculator and it tells you the answer. It's like, okay, but do you understand the logic behind it? I think there's some value in that. So no, that's great. And that's interesting that you use 5% as well. That's, I find that's a good one to use for sure. And then also too, one of the, I guess, big pieces of news that we should mention is that you guys told me recently that you can actually use Passiv for free now. Because before, when you guys were on last time, I remember there was like a free version, but then there was also a paid version. And now you can actually get that premium version for free as well. Can you maybe talk about that part as well?
Right. Yeah, that's a really good point. So as most people probably know that we've had like a pretty strong relationship with Questrade over the years. Recently, we started a new promotion with Questrade where Questrade is upgrading people's accounts for them. So basically, if you create a Passiv account and you link your Questrade account to Passiv, that makes you eligible for a free upgrade to get all the advanced features. So most of the features that we've been talking about on this podcast are, the advanced ones that are paid features, right? Especially things like, one-click trades and all that kind of stuff, right? Or multiple accounts. So basically, Questrade has said, you know what, this is a great tool. We want our users to use it more. So we're going to offer this free upgrade to people.
Mm-hmm. Yeah, so that's great. I mean, that to me makes it a no-brainer because I've been using it and it's something that I think is worthwhile to pay for. And now it's basically, you can get it for free if you're a Questrade user, right? Which is basically the broker that I use as well, primarily because of the free ETF buying, which is great. And then they're basically, and Questrade's basically paying for it. So that's fantastic. That's great.
That's right. Yeah.
Yeah.
It's probably also important to point out that this is like exclusively available to Questrade customers, right? At least in Canada. So we do support other brokerages outside of Canada, but within Canada, Questrade are the only ones we support. Mm-hmm. And there's a number of reasons for that. The obvious one is that no other brokers have APIs that are like open APIs that we can really use, So Questrade is open enough to say, yes, we want third-party applications running on our platform, and they're, willing to allow that, which is amazing,
Yeah.
So that kind of started things, but, due to the relationship we have with them, it's like, well, we're going to stick with Questrade and keep this on their platform.
It's great. Yeah, I remember last time you guys were on, I had the chief technology officer of Questrade on with you guys, with Brendan, your CEO. You guys were just talking about all these integration and the partnerships. And it's really great how, I love how Questrade's saying, hey, we aren't going to redevelop our platform to do all these things that the Passiv wants to do. So here, we'll let you guys do it, and we'll give you the APIs that the technology needed to be able to do this work. So I love how they're so open to working with other companies. It's great. It's great because I can see it being just such a monumental thing for them to develop what you guys have built in-house, because they're using like different technology and all of that. And it's great. I'm glad you guys were able to build that kind of partnership for sure.
Yeah, me too.
Yeah.
I think it's a really smart strategy on their part to be that open, because if you think about how people invest, it seems like pretty much everybody has their own quirks. Even people who are, passive investors and investing in broadly diversified, balanced ETFs and so on, right? They probably have something weird about how they invest. And I wouldn't have thought that a few years ago, but the more users we talk to, the more like feature requests we get. And we get some like really strange ones where like people are just doing something like a little bit weird with how they invest. And we're like, okay, well, that's interesting. It's probably not something that we can build support for, but like maybe there could be an app for that somewhere,
Yeah, for sure.
And without having an open API, there's just no way to get that sort of diversity in the tool sets. So by having an open API, like if somebody has decided that they want this tool to exist, they can just go build it,
Yeah.
You don't need to wait for the broker to bake it into their platform or for, whatever else to happen. It can just exist.
Yeah, and it seems to me that, the brokerages, they've traditionally, looks like, have been focused on more of, the day traders, the people that are just trading all the time, because that's where the brokerages tend to make their money, is on the trades and people doing lots of trades. But if you're a passive ETF investor, I mean, you might be buying, like if you buy an asset allocation ETF, you're buying one ETF, let's say a month. If you're like myself, where you're buying the individual ETFs, you may be buying 4, let's say, or 5 per month. That's so little. Well, and you're buying them for free because Questrade has the free ETF buying. So I mean,
yeah, right.
So I can see it being hard for them to make a business case saying, okay, people are buying ETFs from us for free, and we're going to spend all this money building this giant platform where this is not a huge profit maker for us, because they, I imagine, make a lot of their money on the frequent traders, right? The people that are stock picking and doing multiple trades a day kind of thing. So I like how they basically said, okay, you guys, passive, you guys can run with this, and sort of gave you the tools you need to be able to do it. So that's great. That's great, because that's one thing that I found is with the brokerages, they weren't always the most user friendly to beginner investors, right? Because the platform wasn't built for them. It was built for these people that are professional traders or want to be professional traders, not so much for passive index investors. So I'm glad that you guys kind of stepped in and said, okay, let's make this a little bit simpler for people.
Exactly.
Yeah.
One of the things I wonder about with like big brokerages that are owned by banks is like, if you've ever used their interfaces, they are kind of like old and janky. They seem like a website that's, was designed in 2005 in a lot of cases, right? And that's not true for all of them, but for the few that I've tried, that seems to be a pretty common
I know
thread.
what you mean. There's a very distinct, you can tell right away. Yeah, because you feel like you're 10 years ago using the internet. Yeah.
Yeah. And you wonder, like, well, why is that, right? Are they just not willing to put the resources into building it further, or is there no money in it for them or whatnot, right? And you think about it being under a bank's brand, and the bank usually has large wealth management branches, like they have financial advisors who put money into mutual funds, and that's a huge cash cow for them, right? So why would they want to make it easier for people to invest on their own and avoid those fees?
Right. Yeah, if it looks overwhelming for you, well then, hey, why don't you try one of our financial advisors, and we'll stick you in some 2.5% MER mutual fund, and look, we'll do everything for you. Why trouble yourself with this? So yeah, that's a good point, right? Like
that's a little conspiracy theory.
but I mean, as a business, right? They're gonna put money into where they're going to invest in things that make them the most money. And yeah, they're going to make probably, I imagine, the most money off their, certain high fee products that they can recommend, as opposed to, someone that's buying 4 ETFs a month. You know what I mean? Yeah, exactly. So no, that makes sense. So one of the things I noticed, you guys, when you sent me the list of some of the new features you guys have been working on, you mentioned that one-click trades are now supporting limit orders. And so this is a subject we haven't really covered on the podcast before. The whole subject. I mean, I have it in the course, but just to give everybody, anybody who just listens to the podcast, to give them some understanding, there's limit orders and then there's market orders. Those are kind of the two main ones. Can you talk about? Well, definitely you can talk about the feature that you added, but just so people understand why it's relevant, why it's important, can you talk about what limit orders are versus market orders?
Yeah, absolutely. So a market order is basically when you place an order on your brokerage and you say, I'm going to take whatever the best price is that I can get. So if I'm, buying a share of a stock, well, I look at the market and say, well, here's the bid-ask spread. So the ask is like there are people who are offering to sell their shares in the stock. Here is the best price that they're asking, And so if you place a market order, you try to take that best price. The trick is that when you do that, the market prices can change. So say a stock was priced at $50. You say, yes, I'm going to buy it because I like the $50 price. And you put in your order, but by the time your order actually gets executed, that $50 price has been taken by somebody else, and now it's 51. Well, your trade's going to execute at 51, and maybe you've ended up with a price that you weren't expecting. Maybe you feel a little bit sad about that. It's just kind of like one of the realities of a market order. Is like you're just going to take whatever the best offer happens to be when the order gets placed. The plus side of that is that it gets placed really, really quickly, and it takes a lot of the complexity out of it. And you're generally not getting ripped off by a market order because it is the best price you can get on the market. A limit order is a little bit different in that you're placing an order but saying, I'm only willing to pay up to X dollars for a share of the stock. And if the market price, if the ask price is above that, then your order is just not going to get filled. It'll stay open, and maybe the price will come back down and it'll get filled at some point. But it doesn't necessarily fill immediately unless you've put your willing to pay price high enough above the ask price that it's likely to fill. So personally, I don't really use limit orders. There are like a few very specific cases when I've used them in the past, but for the most part, it's just market orders, and it's because I'm buying ETFs that are like super liquid. The bid-ask spread is almost nil. The prices don't the price of the ETF doesn't fluctuate fast enough for it to be worth waiting around and try to get a special deal, So market orders work really well for me, and they work really well for what Passiv was designed to do. But people are using Passiv in different ways, like I said earlier, people have stock picks on Passiv. Some people have built, instead of balanced ETF portfolios, they've picked 10 or 15 stocks, and they've built their own balanced fund out of these stocks. And if you do that, then you're dealing with something which may not have the same liquidity as one of these massive ETFs. The spread may be higher. There may be more risk in the price of one of these assets changing as you're trying to place an order and so on. And so we've had quite a few requests from people over the years asking for us to support limit orders. They simply say, look, I just never place a market order. Their whole approach for buying things is like they will look at the current market price and they will set a limit order, which is that market price plus a few pennies. Mm-hmm. And that's usually good enough to make sure it gets executed. And it also sort of like has a level of protection in there. So in case there's like a price swing right as they're placing the order, it's not accidentally going to get filled at a much higher price than they expected. Mm-hmm. So for years, we kind of like resisted doing that because we're like, well, it's meant to be an ETF tool, right? And if you're buying penny stocks with it, maybe this is not the tool for you. And so it's one of these like hard product decisions that we have to wrestle with is like, do we build this thing which only a small minority of users might want to use, but it'll be really important to them to have it? Mm-hmm. So we actually did go and build this. We built it a few months ago. I think we released it in February, something like that. So the thing is that like we have to make certain compromises when build these features. So when we place orders, when you place an order through Passiv essentially routes your order to your broker, and your broker executes it. And we need to do that relatively quickly because when we're giving you a set of trades that you need to do to bring your account back into alignment, here's the set of trades. We've calculated it at this point in time based on the current market prices, and all of these trades need to be executed nearly at the same time in order to get those prices. And if you're selling, if you have like a sell order as a part of it, well, then your buy orders won't even go through unless that sell order goes through first. So there's sort of like an order of operations that needs to happen, and it has to happen relatively quickly in order to make sure that this batch of orders gets placed. So with that as the constraint, the orders kind of have to be marketable orders. They have to be something that is eligible to be executed immediately, and it's not something that is going to sit around on your account for a day waiting for it to maybe possibly fill. Mm. So we end up with this constraint saying it has to be a marketable order. So obviously market orders are marketable because you're just taking whatever the best prices you can get. Limit orders are not always marketable, meaning you can set the limit at a price that's simply not going to be met by the market right now. So those are orders that are adding liquidity to the market. If you post an order with a price that's not going to be filled immediately, well, it's just going to sit there in the queue waiting for somebody to fill it with that price. And it may never actually get filled. So the way we do limit orders is that we require the orders to be marketable. And instead of letting you set an explicit price for each stock that or ETF that you want to buy, we let you set an overall percentage price premium that you're willing to pay. So rather than saying, well, here are the 8 things you want to buy or sell, go in and set a price for each of them. We say, well, overall, what is the premium you're willing to pay above the market price? Are you willing to pay 1% more? Are you willing to pay 0.1% more? And so whatever it is, you can figure that, and we apply it to all of the orders. And that way, it's a very simple thing to do, and we make sure that the orders you place are marketable and very likely will get executed immediately.
Gotcha. Yeah.
And it still gives you that protection against a massive swing in price that might give you an unexpected execution.
Okay, that makes sense. Yeah, so it's like a market order, but with a ceiling essentially, so that you don't get too surprised that you don't end up paying more than you really were willing to.
Exactly. It's like a capped market order.
Gotcha. Have you ever, like, I mean, so the way I've always done it is when I was initially, trained on it and started investing, I was always doing the, limit orders, but make it a few pennies higher, if you're buying, and then kind of do it that way. But you said you primarily use market orders. Have you ever gotten burned using market orders where it was just, let's say the markets were just really, really volatile during that time of the day when you were placing the trade, and then, you ended up paying way more than you thought you were going to pay. And then, later the markets kind of stabilized back and you're like, oh, I wish I would have just, done a limit order. Did that ever happen to you with your experience?
For most of my investments, no. The one case I can think where I had a little bit of a feeling like that was I actually had like a speculative stock pick about a year ago. So I bought some shares in Beyond Meat back when it IPO'd, and it did much better than I thought it would. And within a month of buying it, I was like, holy moly, I've doubled my money on this. I intended this to be like a really long-term, investment in the space, and it's doubled its money, and it's crazy volatile. And I don't see how this is justified. I can't handle the stress.
Right.
So I was like, I'm just going to get out.
Cash out while you're ahead. Yeah.
Yeah, it's so volatile that it's making me want to check how it's doing every day, which is not the point, right? So I decided to sell that, but it happened to be on a day when it was like super volatile. So I remember logging into Questrade to sell this, and I went for a market order, just, sell it whatever you can get. The current price on it was like $155 a share or something like that. And when it actually executed a few seconds later, I'd only got like $150 for it. Mm-hmm. And I was like, well, that's kind of odd. Why is that? And so there was like a bit of a larger bid-ask spread than I had thought at the time. But it also did seem to be a little bit lower than I was expecting. Mm-hmm. I mean, overall, I was still happy with it. I doubled my money on it, right? But that's one of those cases where I was like, well, maybe I should have made a limit order. But, also in the past, like maybe 10 years ago when I was first getting into, buying stocks and stuff, whenever I tried placing a limit order, I always found the market would move against me and it would just never get placed. Okay, yeah. and then I would have to come back in and place a higher one. Whereas if I had just taken the market price in the first place, I would have had a better price.
But it's annoying. It feels like eBay, right? Where you're like, okay, I got to increase my bid because someone just bid me. Okay, I got to increase it again. And you just keep increasing. Yeah.
Yeah. And then at the end of it, you're like, if I had just bought it and what it was, then it would have been fine,
Yeah. I think it's an important, it's kind of a, I guess nuance, maybe a bit of investing, but it's worth mentioning. I mean, I had someone reach out to me recently. Like I said before, I've always done the limit orders, doing a few pennies up, and that's what I teach others as well. But I had one lady that took the course, and she was doing what you said, where like, okay, put the limit order in. But the market kept moving, right? And I guess she was trading during a pretty volatile time, and so the price just kept going up and up and up. So every time she put a limit order in, it would be below what it's already trading at, and so she got frustrated, and she's like, "Forget it, I'm just going to do a market order." And so she switched to market order, and then she's like, "Cornell, it was way more than I thought it was going to." Like, I know you told me limit orders, but I didn't want to keep changing it, so I just said, "Forget it, I'm going to do market order." And then it was like, and it was more than what she was expecting. Right, and so it kind of left a bit of a sort of bad taste in her mouth, right? Where so I told her like, okay, well, trade more like during the lunchtime as opposed to like right when the market's open or right at the end where they tend to be more volatile. But I mean, that's kind of I think it's worth. Because it's one thing where you know what you're going to be spending on something. It's another. I can see it being like a psychological thing where it's okay. I'll buy it whatever it's at, and then you see the market spike, and then you're like, oh, I wish I didn't just let it buy it at whatever it was at, and I would have missed the spike, So, that's an interesting. It's an interesting one. You said there was a few times that you did use limit orders. When was that in your case?
Oh, this was almost 10 years ago.
Okay.
Back when I first opened a brokerage account, I bought some shares of AMD, and this was in like the bad years at AMD, right? But I was doing a master's degree in GPU computing at the time, and AMD GPUs were amazing, and I really liked their overall like strategy of like building these CPUs with GPUs embedded on the chip, so like integrated GPUs. And basically, as far as I'm concerned, they were very, very much ahead of the time in developing that sort of stuff and going heavy on like the massively parallel processing angle. And so at the time I was like, well, look, they're like super low valued. I'm just going to buy some AMD and this strategy will pay off for them. And so I used limit orders to do that. And every time I did, like I swear, every single time I put in a limit order saying, I'm just going to, bid a few pennies below the price and get a deal, right? It would just move in the opposite direction. And it was super frustrating. And I'd end up spending hours trying to like shave a few pennies off of one of these stocks. And I learned a bit of a lesson from the AMD stuff as well, though. So if anybody is like familiar with, AMD in particular and how they've done over the last few years, the strategy did pay off for them, but it wasn't until the next generation of chips. So when I invested in 2011, it was probably 2013 or so by the time I got frustrated and pulled out, and I'd lost 70% of what I'd put in, right? Mm-hmm. And I was thinking, AMD must be dead. I guess whatever they did didn't really work out for them. That's too bad. And now they're worth, probably 10 or 20x beyond like what it was when I sold, mm-hmm. right? And so it's kind of like, well, my thinking was right, but I was off by like 7 years. And
that's the whole timing issue, right?
I was right. You can be right and still be wrong.
Yeah.
That's why I try not to pick stocks for the most part. Like it's too easy to just not understand what the market is doing. Even with like, you look at what's happened with this pandemic, right? And a month or two ago, it was all doom and gloom and people's portfolios are down 30% and holy moly, the whole world economy has ground to a halt. That's never happened before. This could be really bad. And now we're pretty much back up at near all-time highs. Yeah, I don't understand how that's possible. It's
so close now.
If I had been a betting person, I would have shorted the market really hard, a month or two ago. And I probably would have lost my shirt for it. Mm-hmm. So, I kind of look at these things and be like, maybe I really don't have an edge and I should just stick to the passive investing strategy.
Yeah, it's hard because there's the professional investors and then there's the non-professional investors who are speculating. But if they're doing it in masses, right, then that can really change things as well. I don't play that game either. I'm just long-term, basically purist index investor. and I don't know, it's been... It's definitely got me through this whole pandemic volatility, and it's been fine. So I'm with you there as well. I don't do any stock sort of speculating or shorting the market or anything like that either. One thing before we move on, I wanted to mention too, because just to finish out that whole conversation about the limit orders and the market orders, one thing that I just thought I'd mention because it throws some people off, and I got this question recently from someone, is that when you see the prices, let's say on Questrade or anywhere, typically they are delayed by around 15 minutes. And so the question I've gotten from someone was, okay, it says the ask price is, let's say, $10. So I say, okay, $10.02, let's say, just to give a bit of a buffer, and then it doesn't close. So they're like, well, what's going on, right? Like I bid over what the ask is by a little bit, and the order is still not closing. What's happening? And it's like, well, the price is actually delayed by 15 minutes or around there. And so by the time you place that order, the market might have already moved way up. And so you might have actually missed that. And so that's what's happening there. And I remember my understanding is that you can get actual live data, but then that's like an extra basically service you have to pay for. And that's more for like day traders or people that are, that really need that immediate stock price information. And so that's not something that really you as an index investor would be or should be wanting to buy, right? And so I just thought I'd mention that because I did get that question recently from a listener of the show, and I can see how that's confusing, right? Because it's like if you go to a store and you see something that's $10 and you offer them $10.02 and they're like, no, sorry, we're at 13 now.
The price has already increased.
But the price says $10 and I gave you more than what you're asking. It's like some of those Shark Tank or episodes, right? Where they're like, they come in asking for like, $30,000, and then the Dragons offer them that, and they're like, actually, no, I'm not going to take the deal. I want more than that now. And they're like, what the heck? Well, you told us one thing, and now you're doing another. But anyways, this is just a side note, but I just thought I'd mention it because it was. I think it's a good question, and I can see it being a point of confusion for some people. So let's move on. One of the other things I noticed you guys added was the advanced currency handling. So you can basically to help people invest with multiple currencies. So I personally I use the Norbert's Gambit technique to do the cheap currency exchanges, but I realize that's like beyond the scope of this particular episode, because that's like its own podcast episode that I'll have to do sometime. But I realize that technique can be intimidating, and it's really not the best for beginner investors. So what is a good alternative? Since if you want to buy something that's a stock or ETF that's in US dollars, what's a good alternative? Because my understanding is that the currency conversion fees are pretty high if you just go with your bank or if you just go through a brokerage. So that's why I use Norbert's Gambit. But for anybody that's not willing to dive into that sort of deeper end of the pool, what do you like? What do you suggest? Do you have any opinions on that?
Yeah. So if your goal is to convert Canadian dollars to US or the other way around, there's really not too much of an alternative to doing something like Norbert's Gambit if you're looking to save on fees. You could always try to withdraw your cash and then exchange it somewhere else and put it back in the opposite currency. And you could do that. But again, it's slow and you're still going to pay a currency exchange rate somewhere. Right. So it's really hard to avoid those fees. But if you're not trying to buy, like if you're trying to buy, an index, for example, that represents like the S&P 500, you don't have to buy that in US dollars, even though it's a US index. There are Canadian ETFs that represent that same index, and you can buy them with Canadian dollars. And you can buy them in forms which are either currency hedged, which means that it's like you don't expose yourself to the currency risk when you purchase it. You're going to basically get the S&P 500 returns as if it were denominated in Canadian dollars versus US dollars, or you can buy the straight up one, which is like you get the returns of the S&P 500 as well as whatever shifts there are in USD CAD currency, right? So you don't have to exchange directly to buy a lot of these things. You can buy, Canadian versions of them. Now, often the fees on those ETFs are slightly higher. So just looking at like Vanguard S&P 500 ETFs, the US version of it has a fee of 4 basis points. It's super, super low. And the Canadian version is more like 10 or 15 basis points. So it's still very low, but it is higher. So it's just kind of like, how much money are you investing? Think about how long it would take to try to recoup that currency exchange fee if you were transferring it to US dollars and back again. Most platforms, I think, take around like a 2 to 3% fee if you were doing like a round trip between US dollars and back to CAD. Mm. So it would take a long time for those basis points to add up.
Yeah. So it sounds like, generally speaking, if you're like, you shouldn't buy, like, let's say you want an S&P 500 ETF that's in US dollars on the US market because its MER is a bit lower. Generally, you shouldn't do that unless you're able to get the currency exchange to be really, really low, like by using the Norbert's Gambit technique, for example. You're better off just buying the Canadian version of that, right? That's your stance on that?
Yeah, that's right. Yeah. And the reason is the brokerage, they'll charge 1.5% or whatever for moving from one currency to another, which is a lot, right? Yeah. Like that's a substantial amount of money. But your bank is going to have the same rate or worse, you know? So you need to go to like an actual Forex clearinghouse to get your money changed and get a better rate. And even then, they're still going to take a piece of it because that's how they make money. Right.
Yeah. So it's kind of like, in your effort to lower your MER by a very small amount, you're paying way more than that just on the currency exchange. So it's like, what's that expression? Don't miss the forest for the trees or whatever that is. something
exactly.
Like that. Yeah. Yeah. I mean, the way that I did it, just kind of through my investing life, I guess you could say, is when I did not feel comfortable using Norbert's Gambit, when I just was in the kind of the beginner investor stages of my life, then I just did what you said, and to get exposure to the US market, I just bought a Canadian traded ETF that represents the US market. So something like, VFV or VUN, those kinds of XUS was another one I remember, just, listening top of my head. So those kinds of ETFs. And then eventually what happened is I don't know if you care about this or not, but I'm just telling the users or the listeners, because I think this may be helpful to make investing less overwhelming if you're just getting started. But then eventually, once our portfolio got big enough and the allocation that we had in the US was significant, then I became a more experienced investor because I've been doing it for years at that point. And then I said, okay, the money's big enough, the savings are big enough. Let's now actually learn Norbert's Gambit, how to do it properly, and to get that really cheap currency conversion and do it that way. Because there's the other benefit too, whereas if you hold that when you hold the U.S. market, that in a U.S. listed ETF, then and you do that within your RRSP, then basically you save money on the U.S. Dividend, the withholding taxes as well. So that's pretty much the main reason that I do it. But that's more like once you're years into investing and the amount's big enough where you're like, okay, I'm ready to sort of optimize things to that next level, right? To get like, I'm already like 80 or 90% there. Let's get it back. Let's get it even closer to 100. So that's the way that I've personally approached it. And I think if I was to do it all over again, I think I would do it that way too. Because you do want to sort of...
I think that's exactly the right way to do it.
Okay,
yeah.
Awesome. Yeah. Because you want to get your sea legs under you at first, right? Like you want to...
That's
you're
right.
Be like, I'm going to buy my first ETF. Oh, and let's do Norbert's Gambit. Because if you go down that rabbit hole, you're going to get overwhelmed. At least I would have. Like if I started investing, I looked into it and I was like, okay, I'm not ready for this yet. Let's invest for a few years, get comfortable, and then we take it to this next level. Yeah, and if you're just doing, and you're not going to, it doesn't make sense to do it if you're just buying a little bit of currency anyway, right? Like you want to make it, it has to be a bigger amount to make it worth your while because you're still going to pay transaction costs, right, on doing that conversion. So,
that's right.
Yeah. Anyways, but it's interesting to hear that you're also, you also agree with that sort of process.
I think that applies to like a lot of things in life. Is like avoiding premature optimization.
Yeah.
Like don't make things more complicated than they need to be until it actually matters.
Yeah.
We have the same thing in software development. It's like we think about the trading engine that we've built to calculate what people need to do with their account in order to follow their target, and it's getting pretty complicated now because of the currency handling we have and the multiple accounts and being able to group accounts into portfolios and all that stuff. That makes the calculations fairly complicated. And at this point, the calculations are a little bit slow. Like they still happen quickly, and like as a user, you won't notice that they're particularly slow, but when you're doing it for thousands of accounts on our servers, it adds up. And so, for us, we look at it and we're like, well, we could optimize it. We could probably make it 10 times faster if we did X, Y, and Z. But when we do these things, we know that we're actually going to be making the code a lot more complicated. We're probably going to be introducing really subtle bugs. It's going to make the code less maintainable so that it takes more time to fix it and change it as we add more features. So it's like one of these fundamental trade-offs where it's like, yeah, you can have it fast or you can have it correct and good, right?
For sure. For sure. And then, when you try to optimize things too fully, too quickly, it's easy to get out sort of paralysis analysis and overwhelm and then just kind of put on the back burner and say, okay, I'll keep researching it. I'll keep looking into it. And then it's like, okay, a year has gone by. You still you have the money sitting in cash. You still haven't invested. You might have just missed a really big rally just because you were trying to get 100% optimized right off the bat. You know what I mean? So I think there's something to that as well. So I think, it's okay to start off like 80% optimized and then just keep moving towards that 100%. And then like the little minor optimizations won't even make that big of a difference if your portfolio isn't that big anyway. Actually, so total side question. At what point do you think people should start to really start optimizing the portfolio to kind of the further, more advanced levels, like, using Norbert's Gambit, for example?
Well, there's definitely like a continuum of optimization, right? So like you could say like, well, the easiest way to invest is to just put money in your savings account, and you're not really investing, but you are saving. And, the bulk of your performance, at least in the short term, is just how much you save, right?
Right.
So you can do a pretty good job at investing if you're just dumping money into a savings account for the short term, And then, the next thing is, let's make it a little more complicated. We can put money into mutual funds or into a robo-advisor. So it's a fully managed option. We don't need to think about it. It's very easy. And probably the money will grow a little bit, And that works as well. And then like kind of the next step is, now once I have, say $50,000 or whatever, right? Once it's enough money that the fees start becoming important, now you think, maybe I should consider a DIY approach if I have an appetite for that, right? And you could do something like a basic couch potato portfolio or something, right? And then once you have a few $100,000, then you're like, okay, now the fees on this there are still fees and there are still costs and there's, withholding taxes. If I optimize this, then I can save so many dollars a year, right? So I always try to convert it back to like equivalent dollars per year.
Mhm.
How much is it actually costing me to not make these changes? What's the opportunity cost?
Yeah.
And I personally, like, I'm still on a very basic couch potato portfolio. I have a few $100,000 in my retirement portfolio right now, and it's not to the point yet where it's worth it to me to do something a little more complicated, like the Canadian portfolio manager strategy for reducing taxes and so on.
Mm-hmm, mm-hmm. Yeah, it's worth mentioning, right, that a lot of these optimizations, at least in the investing world, it seems, at least from what I've seen, is that it's like a percentage basis of your portfolio. So it's just you're trying to shave off a percent of a percent, basically, like little minor things. And so on like a $50,000 portfolio, half a percentage point is not that much money. Whereas on a $500,000 portfolio, all of a sudden to pay an extra 0.5% or 1% every year is all of a sudden pretty significant. Let's say you're paying someone 1% fee to help you manage your money. Well, on $1 million portfolio, that's $10,000 a year that you're paying them, right? So then it's this question of, well, are you getting good value out of it? Whereas if your portfolio is only 50,000, well, 1% on that, it's still something, right? But it's obviously a lot different than the $10,000. So, so I like your approach of just actually thinking, okay, how much am I really paying for this based on where I'm at, and then deciding whether you should whether it's big enough to actually pursue these other optimizations. Let's talk about the cash management rules that you guys did, because I know you guys started doing things with dollar cost averaging as well. Can you talk about, first, just for anybody not familiar, what dollar cost averaging is and why it's important, why you should care, why is it a tool you should be aware of in your investing toolbox? And then how did you guys deal with that in Passive? Because I believe that's a new feature you guys have as well.
Yeah, for sure. So this is like another one of these classic features where, like, we've been thinking about having better cash management stuff for a long time. Pretty much within a few months of launching Passive, we had people saying, hey, I want the ability to do something with my cash. I want to, either withhold a very specific dollar amount indefinitely, or I want to only invest a certain amount with this set of calculations, right? And it was never like a high enough volume of requests for us to consider doing it. So that's kind of like one of our guiding development principles, is like, how much are people demanding it? And if it's only one or two people every month asking for it, that's not really, a huge number. Even though, you want to service it, but you have to recognize that you're also impacting all the other users by introducing this little extra bit of complexity, and by focusing on this versus the other things we could be doing. So the reason why we did it recently is directly like as a response to the pandemic. So it's not something that we had planned to do. It's not something like we didn't have a roadmap saying, okay, when the next market crash happens, we will do this. It was more like when the market started tanking, all of a sudden we started getting a lot of requests from people saying, hey, I just contributed a bunch of money to my account so that I can, buy the dip, or, kind of gradually rebalance my portfolio, and I want to allocate it slowly. I want to dollar cost average this in. How do I do that? And up until that point, the answer was, well, you could just like set up recurring transfers from your bank for, say $1,000 a week or whatever it is you want to contribute. And when that money hits your account, Passive will allocate it for you, and that's kind of like the way that we've told people how to do it up until now. But with the pandemic, people have not just been putting new money into their accounts, but they've also been having to rebalance. And a lot of people say, well, I want to do a rebalance, but I don't want to purchase everything immediately. I want to sell the things that are overweight, but I don't want to reallocate that right now. I want to take that $20,000 or whatever it is and allocate it over the next month or two, so that I'm not necessarily, like, basically, who knew how deep the dip was going to go? So they didn't want to do it all right away. They wanted to spread that out over time because everything was so volatile. And so that was when we realized, like, okay, this is something we really need to support. This has gone from like a very niche thing to something that we're getting, 10 or 15 emails a week demanding this. So we have to build it. And so that's what we did. So we basically built these cash management tools to help people do two things with their cash. So one would be the dollar cost averaging thing, where they only want to allocate a certain amount of cash at a time. And the other thing is for people who want to just retain a fixed dollar amount of cash. And so, we've always kind of like had the ability to keep cash in your account. So cash can be a part of your target, where you can say, I want like 20% of my portfolio in cash. And we will just calculate whatever that happens to be as it's being calculated and say, this is the cash target, and we're going to make sure that much stays in cash. But that's an amount that's like proportional to your total portfolio value. It's not a fixed dollar amount. So this cash management thing is like, now you can just add a rule and say, I want to keep $3,000 in my RRSP as cash, or I want to keep, and you can basically set the currency, you can set the account you want it into. It gives you like a very fine-grained level of control over how your cash is managed in your accounts.
That's very interesting. Yeah. And I mean, we'll have to do an episode sometime on dollar cost averaging just as a whole, sort of to discuss the pros and cons of each, because I get questions like this periodically as well, where people will say, okay, I don't know, sold the business or sold the rental property, or just, I don't know, got an inheritance, or maybe they just got a big bonus at work and they want to invest it. Should I do it all at once, or should I spread it out over a certain period of time? And so there's really pros and cons of doing it all at once versus spreading it out. From all the research that I've seen, you have a higher probability of gaining more if you do it all at once, but that's not a guarantee. So you may also get unlucky, and you may actually end up worse off by doing it at once. But the math from what I've seen has shown that you are better off doing it all at once. But there's that's just the math piece, right? But then there's also the whole psychological component of, okay, you just sold your business for whatever it is, or you just have all this money, and we're in the middle of a pandemic and the markets are being very volatile, and you just don't, even though the math says one thing, you just don't feel comfortable, let's say, plowing $50,000 in all at once on a single day into these ETFs. And I think that's understandable. I mean, that's pretty, you have to really believe in, in the math, and you have to have a certain type of temperament, I think, to feel comfortable doing something like that. And so I can see why people choose the dollar cost averaging route, because, there are some psychological sort of benefits to it, and you're just trying to minimize the downside as well. So I guess
absolutely.
Yeah. So I like how you guys added that in, because people, especially with this pandemic, right, and how things have been going. It's I've been talking to a lot of people, and yeah, I mean, people aren't sure. Are we going to have another giant dip really soon? Are we going to have another 20% correction, even though now we're almost at back highs, right?
Maybe we're in a bull trap, right?
Yeah, like, so nobody can consistently correctly predict these things, right? And so it's understandable if someone's got, let's say, 20K, 10, even 10K to invest, maybe you don't want to do it all at once. Is there when it comes to dollar cost averaging, do you have a certain time frame that you like to use? Like, for example, let's say someone has, let's use $10,000 as an example. Do you have a certain time frame in the sense of, would you say, okay, I'm going to spread that out over 12 months, so split it into 12 equal chunks and invest all that over the course of a year? Or do you have something else, like, I'd like to use 6 months, or I'd like to use a quarter, or I'd like to use a few weeks? Have you looked into it at all? Do you have any sort of preference?
Personally, I look at dollar cost averaging as a way of like damping the volatility in a market, right? So if you have a chunk of cash to invest and you're worried that you don't know if you're at a peak or a trough, you want to just kind of average it out, right? But that doesn't mean you necessarily need to average it out over the course of a year. If you look at how the markets were swinging a couple months ago, like they were going up and down 5% every day. Like, there's no way I personally would be able to sleep at night, putting a large chunk of cash into the market on one day, knowing that I could just lose 5% just like that.
Yeah, the next day you wake up and whoops. yeah.
But if you average that out over like even 2 weeks, like you've already removed most of that volatility. Mm-hmm. So for me personally, I don't look at it as like a long-term thing to do, other than in terms of like ongoing contributions. Like, yeah, I'm contributing, say $1,000 a month. Well, that's going to happen forever. And that is a form of like dollar cost averaging to some extent. Right. But in terms of like just a lump sum, I personally would be much more biased towards getting it into the market as soon as possible, but just trying to filter out whatever daily volatility there might be. For
sure. Yeah. I mean, for one, the markets do go up more than they go down on average if you're
exactly right. Investor. Time in the market beats timing the market.
That's right. Yeah. So I mean, there's that. incentive, I guess, to to put it in sooner rather than later. And then also, I mean, you could be, if you stretch it over something long, like I would say a course of a year, you're also now missing out on dividend payments as well, right? Because that money is sitting in probably a high interest savings account waiting to be invested. And yeah, you might be earning some interest on that, but you're also missing out on dividends if that was invested. So you're missing on dividends for sure. And you could be missing on some massive capital gains because the markets do tend to go up more than they down. Historically, that's always been the case, and that's why we invest, right? So, yeah. So I think that's it's a tough one. I think a lot of people kind of struggle with that, and I have yet to find sort of an optimum consensus from experts in the field that say this is the ideal time frame to a dollar cost average over if you are going to do it. Because I guess it's very situational. Depends on the person too. Yeah.
Yeah, very much so.
Okay, awesome. All right, so we just had that crash not too long ago, the COVID crash. We've seen quite a bit of a recovery as well already, like we've already talked about. What are your thoughts on the crash, and how has it affected what you see passive users doing?
So we were speaking earlier about cash management, and that was kind of like an interesting thing because it took something that was a relatively niche feature request from users, which is like allocating cash over time and doing dollar cost averaging, and it just brought it front and center immediately. And that kind of made me realize, okay, people are reacting to this. Clearly the market as a whole is reacting to it, but even passive investors are reacting to it. The question is, are they reacting in a positive manner or a negative manner, right? Like, are they scared? Are they doing things that maybe they shouldn't be with their portfolios and so on? It seems like, for the most part, that passive users at least have reacted pretty well to it. They've taken this as an opportunity to rebalance their portfolio. They've taken it as an opportunity to basically, a lot of them have decided, okay, well, I have this cash setting aside. Now is a good time. I'm going to buy the dip and I'm going to invest at this point, right? And whether or not that's a good strategy overall, like you're catching a falling knife whenever you try to invest in a dip. But it also means you're getting a better price than you would have a week or two before, So it seems to me like they've done a pretty good job at reacting to it. And we don't like look at individual accounts or anything like that, but we do have like overall assets invested statistics that we keep track of just to get a sense of like, well, how much money is being managed with our tools and so on. And there was about a 15% dip from our highs, like prior to the pandemic. There was about a 15% dip in the aggregate amount of money that was being managed by passive. However, by now it's gone right back up. Mm. So it seems like whatever people are doing in their accounts, they've actually managed pretty well through this pandemic, and they're, for the most part, back where they started, which is super interesting. If you had asked me, a month or two ago whether or not that would be the case, my answer would have been like, oh no, this is going to be a long haul, recession, and it's going to go on for a year or two. We don't even know when people are going to be able to go back to work. We don't know if schools are opening in the fall, right? Like, we don't know any of that. And there was just so much uncertainty that it was basically impossible to predict how it was going to go. Right now, everything looks optimistic, but maybe this is also a trick. Maybe it's just a result of the amount of money that the U.S. Federal Reserve has been printing and pumping into the market. It's really hard to say, and it's not for me to say. It's not for individual people to say. It's kind of like, well, you had a plan. Now is the time for you to decide whether you're going to stick with it, and honestly, it shouldn't even be a decision. It should be like, you made that plan. You should stick with it. That is the whole point of having a plan,
Right. And I mean, we knew this was going to happen, not in the sense of we knew COVID was going to happen, but we knew even if you start investing, 5 years ago, 10 years ago, you knew there was going to be another correction of some sort. There's going to be another crash. There always has been. It's not like, oh, we're in a 10-year bull market. It's going to continue indefinitely, right? So we knew there was a drop going to come. We just didn't know what it was going to be from. Turned out it was COVID. And so now it's kind of...
right out of left field. Yeah. Nobody saw that.
Yeah. So, I mean, now it's kind of a time where you get to see, okay, how's my asset allocation now that I've actually experienced that dip? How was I able to sleep through it? Was I stressed out? Was I freaking out? So yeah, I think it's a good reflection time for investors to see, because I remember too, like I'm 30, turning 36 this year, And I remember one of some of the older investors that are like, in their 50s, and, they would say things like, oh, well, you young guys and girls, you've never really experienced like a gigantic decline, right? Because when 2008 happened, you were maybe like fresh. Like in my case, I was fresh out of school when, like, my first job when 2008 happened. And so I didn't have like a giant portfolio at that time, so I never actually got to see a large sum of money drop that significantly, right? And so I've seen this argument made frequently by sort of the more older investors saying, well, you think you can be heavy in equities, but you don't really know because you've never experienced such a big decline. So how do you know that you're not going to just sell it all and freak out when it actually does happen, right? And so I remember that was weighing on me quite not a lot, but it was definitely in the back of my head saying, okay, I know what, like, I've done all the risk assessments and all that, and I know I can handle my allocation, like theoretically, but it's never actually, I've never really truly been tested, right? Because we've never had a 30% drop in my investing history or whatever, right? So this is kind of, I guess, for anybody that's younger listening that didn't have a giant portfolio when 2008 happened. Now you know how you react to these things, right? Now you know your temperament, your personality as an investor, whether you truly believe in long-term investing or whether you just need something more conservative. So no, I think that's I think at least that's one thing that it's a bit helpful, right? To kind of like the self-knowledge and self-awareness.
Yeah, absolutely. One of the things that surprised me, not with this recent market crash, but previous ones, and not even like regular stock markets, but like cryptocurrency markets are an excellent example. Is like just how psychologically stressful it can be when you see how much money you lost, and even if it's not a real loss, even like a paper loss can be very very distracting. So. I got like my story, part of my story of getting into investing is like I had Bitcoin back in the day. So in 2010, I thought, I found out about Bitcoin and I thought, hey, this is like really cool and interesting. And like, I'm a bit of a nerd. I'm like, well, this is cool. I'd like to contribute to this. This is like an open source project. It's a community. It's a movement. I'm going to mine some coin. This is going to be cool. And so I did that for a while. I mined some, I bought some, I traded for some. And in the end, I ended up with, I had a few hundred Bitcoin at one point.
Nice.
Yeah, which was worth almost nothing back in the day, right?
Right.
So, my like total cost of like getting that many Bitcoin was like $400 or something, like it was
wow.
Nothing,
yeah,
right?
Yeah.
And in the time between, 2010 and now, there's been like, I think 3 major like pumps and crashes in the Bitcoin, and not just Bitcoin, but cryptocurrency as a whole, and all of them are really bad. Like it's not like you see like a 20% drop. It's like the markets will often change by 10 or 20% on a daily basis. It's pretty common. It's I almost look at the cryptocurrency markets as like this weird, super amplified version of the regular markets where everything happens on faster timescales and it's so much more severe.
Yeah.
So the first crash that I experienced was after, let me see, this was in 2011 or 2012. I can't remember the exact dates. It was one of the earlier ones, but like the price of Bitcoin had gone up to like $36 and I had made several thousand at that point. My money had gone up like almost 10x. And I was, I was thinking, I did a really good job at this. I'm super smart, right? And then the bottom fell out of the market and it went down below where I had even gotten in, right? So where at one point I had, I was up 500%. And then, just a few weeks later, I was now down at like minus 50% relative to where I'd gotten in. And if, you look at that relative to where you got in, 50% is a pretty bad loss, right? When you look at it compared to what the peak was, and that's what everyone compares themselves to is the peak. Oh, if I had only sold at the peak, right? That's like 90% losses. Like it's really bad.
Yeah.
And that's stressful. And then that happened like 2 or 3 more times as I, kind of gradually sold. And as the price went, I kind of gradually sold. So I didn't actually end up with that many Bitcoins at the end of it. But, it was like a learning experience for me on just how painful it can be to see your wealth evaporate, even when it wasn't really real wealth to begin with,
Yeah. It's funny. I have a friend who got in pretty early with the Bitcoin and he's just, the volatility of it has made him so numb to volatility. So I remember,
Yeah.
I just because it's so relative, I know what you're used to. So I remember talking to him like, "Oh man, the market just fell, 5%," and he's like, "5%." He just kind of just shrugs that off because he's like with Bitcoin, I'm used to like double digit declines and increases over like a day. It's
Yeah.
so it's interesting how it's all relative, right? And what you're used to and your psychology and how whereas there's some people, right, where they see like a 2% drop in a day and they could be panicking, right? So yeah. Hence all those risk assessment questionnaires.
Yeah, it's great training.
Yeah. So just so you know, this can happen, and it does happen. So there you go. Yeah.
Yeah.
So yeah, let's talk a bit about market speculation. So as we're recording this, we've seen a massive drop in the market due to COVID-19, and then now recently we've seen a very rapid recovery. And so just from the conversations that I've been having, it seems like some people are speculating that we're going to have another large drop, while others are in the belief that the worst is already over. So how do you personally invest? How do you deal with this kind of speculation? And what do you think we should do when we get a hunch, and I'm using air quotes here, like a hunch, that the markets are going to go up or they're going to go down in the future? I mean, I think we all maybe get these hunches from time to time. How do you deal with it? What do you think is the best way to approach this kind of thing?
I personally am not good at predicting where markets are going to go at all. And I know this because I've tried to do it. I've also done paper things where I've said, wrote a note to myself, I think the markets are overvalued and will decline below this level by X date. Right. And I kind of test myself on this and I'm always wrong. It always does the opposite of what I say. So, in terms of steps I would take to approach it. Number one, I would say ignore it. Number two, if you can't ignore it, try doing the opposite of what you feel like doing. It's me personally, I have a really hard time having any sort of certainty about where things are going. And I've kind of learned that about myself. And so now I know that, and I kind of factor that in whenever I'm feeling scared about something or, I think I've got this cool thing that nobody else notices. I mean, the answer is you probably don't, you think about the major investment banks, and they've got armies of PhDs whose job is to find these diamonds in the rough, which are undervalued companies or companies that are have this new product or development on the horizon that's going to fundamentally change the nature of their business. They've got people in there and they're finding about all of this stuff and they're placing their bets on that, and they do it not just for the big companies, but for every publicly traded company. So there's not a lot of, diamonds in the rough that you can find on your own, at least being relatively sure that this is what it is, So just knowing that and knowing that, even the big investment banks don't see massively outsized returns on their investments makes it seem to me that, for the most part, doing that sort of in-depth research into companies, there's, not a lot of money you can make as an individual. And so it's probably better to avoid it. Now, that said, people like to invest in things they believe in, I think that's one of the big reasons why Tesla is so highly valued, If you think about what the company would have to do to ever really justify those valuations on a fundamental basis, they pretty much have to own the world automobile market.
Right. Well, we had
right?
something similar happen with the marijuana stocks in Canada, I remember, not that long ago.
Yeah, exactly. Right. It happens to
that.
Yeah, and I think it's people being excited about it and seeing that this is something I believe in and I want to happen, and I don't, they don't even do the fundamental math on whether a valuation is justified. They're just saying I want to be a part of this, and so they buy it. And it's enough people doing that it inflates the value. Now, obviously, fundamental analysis is not the only way to look at things, because if you look at, there are lots of stocks out there that have essentially defied gravity for a decade. It's their consistent valuation is way higher than what should be justified based on how much money they're making, but it stays up there. It doesn't go down, So at what point do you say, well, the markets are simply wrong and they're always going to be wrong, versus there's this extra thing, which is people's enthusiasm that you need to factor into it,
Yeah. And you mentioned the banks with their teams of PhDs. So, I mean, they have the staffing for it and entire teams, as opposed to, you as one individual person, a solo show, trying to beat someone, make the right bets. But they also have I'm sure they're probably spending millions on the different tools to analyze these different companies and all these different variables and all these different models that they have. So it's just to reinforce the point that you're making about how difficult it can be to win, especially when you're competing against basically these teams of PhDs who also have these massive resources where they have data and models that we just don't have access to as regular retail investors, essentially, right? So it's pretty hard to do that consistently, for sure.
Yeah, totally. On a more broad sense, like, there's two sides of the speculative side of things. You can speculate on individual stocks, or you can speculate on the market as a whole. And that's like the concept of buying a dip, like if there's a short-term market correction, well, maybe I should plow some extra money in, or maybe I should have been holding back money all this time, ready to deploy it when that dip happens, And that's also really hard to pull off because you never really know when you're at the bottom of a dip, and it's hard to know when something is really truly overvalued and due for a correction versus no, that's just the way things are going. One of the examples I like to use is Alan Greenspan giving a talk about the dot-com bubble back in 1996. So in December 1996, Alan Greenspan, who was the Federal Reserve Board chairman at the time, so he gave a speech about the state of the stock market. And so this was, pretty much in the early days of the bubble. So the internet was new, but it was clear that it was going to be a big, important thing. And everybody was super hyped up about it. And the market was just going bananas. And so he used this term called irrational exuberance to describe what he saw the market doing. He was basically saying there's too many people who are being irrational, and they think this is going to go bananas forever, and they think they're all going to get rich. And it was basically a comment to say that his opinion was that everything was way, way overvalued. But, and this is the really interesting thing, if you look at the value of the U.S. market over time, you look at the aggregate value on the date that he made that speech, and you'll see that the value of the market has never been lower than that. It's never gone back down below that point. So even when the Federal Reserve chairman tells you that everything is overvalued and this is bananas, well, guess what? That was if you bought in any later date, you'd be getting a worse deal.
That's fascinating. Yeah, and this isn't some talking head on the business news or whatever that's just speculating, because they have some money to make if you buy their mutual fund. I mean, this is Alan Greenspan. I mean, a reputable source in the in that field, right? And still he can be wrong. So yeah.
Yeah, so it just shows how difficult it is to call a bubble. And you don't just have to call a bubble, but you have to be able to predict when it will crash and by how much it will crash. And, he did call it a bubble, and it turned out to be a bubble, but it never crashed down below where he called it a bubble,
Right.
Yeah.
Well, hence, before we were talking about dollar cost averaging, not in the sense of investing a giant lump sum, but in the sense of where, let's say, you invest every single month with a portion of your paycheck. And so, that to me, because no one can really predict these ups, these downs, these peaks, these troughs, really the only thing that kind of is within our control that we can do is just consistently invest a certain amount, and that way you're going to be basically riding it, as opposed to just sitting on cash trying to time it because, Alan Greenspan was able to get it wrong, and so was everyone. People aren't able to call it consistently. So yeah, that's the best way to do it, I think.
Yeah. That actually ties in really well with our performance reporting page on Passiv, right? Like I was saying, we have. We designed it to help you look at the things you can control versus the things you can't control. And so clearly you can't control what the market does. That's an external thing, and you want to try to benefit from that, but you can't control it. What you can control is how you invest. And better yet, you can control how frequently you invest and how much it becomes a habit. And so that's one of the guiding principles to how we designed this reporting dashboard, is so that you can see how consistently you've been hitting your investing targets and just socking away that cash. And, if you're doing that on a monthly basis, you're dollar cost averaging. You're already spreading the risk out over time, and doing so in a way that pretty much guarantees you're going to do well, in a long enough time frame.
Yeah. Yeah, like how you have a thing where it says net change in terms of your contributions. And so, yeah, it's easy to check, are you consistently investing? And it prevents you from maybe, trying to lie to yourself like, oh, I've been doing fine. I've been contributing a lot or whatever. But then you look and you're like, oh, I've actually taken some money out and I never ended up reinvesting it and things like that. So it kind of helps keep you, I think, accountable as well, because these are actual numbers being pulled from your Questrade account. So
exactly. It's all true.
It's all true. It's all true. Yeah. I like how you guys show the cash balances too. So when dividends get issued, you show that basically what your investments are worth, but also how much cash you have sitting in your account. So when dividends are issued, they show up as cash, as I think most people know. And so it's always nice. You check your portfolio balance and you say, oh, I've got, let's say, a few thousand in dividends here of cash now that just arrived in my account. So okay, let's invest that money. So I thought that was pretty nice too. Instead of having to like log into each account and say, okay, how much cash do I have in this one? How much cash does my wife or husband have in their account after the dividends were issued? So I find that's pretty useful too.
Mm-hmm. Yeah, the cash notifications were like one of our first features, like other than the basic calculations, but it was like being able to tell you when it's time to look at your account. And so we basically just check for new cash deposits or dividends. And when we see them, it's like fire off an email and it's time to come in, check your account and do something about it.
Yeah, it kind of prompts you to, no matter how busy life gets, you get prompted, hey, just you're sitting on cash now, go do something about it. Yeah.
And it only takes a few seconds, right? You log in, and it's like, here's the button, all the trades are prepared, just push it, and you're done.
Right. It's a good thing to prevent procrastination, I find, right? So I find that's really useful. And as a total side note, it's nice to also, I always like getting those emails because it's like, it feels like a mini Christmas, right? Like,
you love knowing when you get paid.
Because I mean, like that's like the true passive income to me is investing, right? Like you don't actually have to work hours to earn that money. So when someone sends you an email saying, here's some money that you don't actually have to work hourly for in a job, that's always a good feeling. So I get these little, I get a smile every time I see it. It's like, all right, it's nice. Okay, that's great. So that's all that I had. Did you have anything else you wanted to talk about or add or anything like that?
No, that's pretty much it. Like, I really enjoyed our conversation.
Awesome. Oh, actually, no, I just have one question, just total side note. So with how you personally invest, do you just do total broad market index investing, or have you found, do you actually focus on, because you know how the Canadian market isn't necessarily the most balanced in terms of industry diversification. Do you tweak your portfolio a bit so that you're more represented, or do you just go with a total broad market index?
I follow a couch potato portfolio. So Dan Bortolotti's Canadian couch potato stuff. It's not the current one. The current one is basically say just buy one of the all-in-one ETFs, which works and it's easy and whatever, right? But I'm following one that was published in 2017, I think, and that was the one that recommended like all the Vanguard funds. It was like so it was basically the Vanguard Canadian Index, Vanguard Canadian Bond Index, and Vanguard's World Index minus Canada.
Okay.
And so that kind of gives like the geographic separation so that we can consider, well, everything else, and then here's the Canadian component and so on, right?
Gotcha.
So I basically started following that years ago, and I just stuck with it. And, there have been tweaks to it since then, but I've never really followed the tweaks because this works really well. There's almost no point in changing it.
For sure. That's what I find too. When people ask me like, oh, are you buying these totally new set of ETFs every year or something like that? And it's like, well, no, it's not like these ETFs have become flawed in some way. I mean, you can just hold them and just keep buying them. So no, I invest in the same way. I buy the individual ETFs as well, and then I make sure they go in the right accounts so that they're most tax efficient and all that. So we both invest in the same way. I'm trying to get in a habit of asking guests how they personally invest, because sometimes we talk about theory and the research we've read and what we do, but then it's like, okay, when the rubber hits the road with your own hard-earned money, how do you actually personally do it? But it sounds like you pretty much do with this same sort of overall strategy investing style as what I do. So very cool, awesome.
Great.
All right, well, thanks for coming on the show, Brendan.
Oh, thanks for having me. I really appreciate it, Cornell.
All right, thanks for tuning in. I definitely encourage you to try out Passiv, as all the premium features are now free if you're a Questrade user like myself. Then basically you get all of them, and I mean, it's great. The reporting functionality is fantastic. The time-saving tools are just amazing. I've been a big fan now, using them for quite some time, and now I'm just absolutely hooked on the reporting functionality they added, because it gives me such good insight in terms of how my investments are doing and how much I can expect in dividends and all of that. It's just really, really awesome. So, big shout out to them, and thanks guys for for building such a great tool. So yeah, just to give you a bit of a recap, in case you aren't sure how to get all those premium features for free, first you got to go to getpassive.com, you sign up for the free account, and then you just follow the prompts to connect your Questrade account to Passive, and then basically just accept the upgrade offer that's presented, and then you're all set. So very, very straightforward. If you're an existing Questrade user, you go to getpassive.com. So remember, that's Get Passive without the E at the end. Or if you have trouble remembering that, just go to buildwealthcanada.ca/passive. That will automatically take you there too. And then sign up for free at Passive. You go to the settings tab, and in the subscription panel, you'll see there you can click a button to get the free upgrade. So they made it pretty easy. But whether you're a new Questrade user or a new Passive user or not, you're basically able to get everything now for free, whereas you couldn't get that before. So awesome. And definitely, don't forget as well to sign up to the Build Wealth Canada newsletter, so I can send you my PDF on the other tools that I like to use for my finances and my investments, and so that I can send you free tickets to the Canadian Financial Summit happening this September, where I'm bringing on over 25 Canadian personal finance experts to help you retire early, invest better, lower your fees, pay less in taxes, and help you learn the best practices when it comes to personal finance and investing, so that you can hit that financial independence number years earlier. So that's all free as well. And really, just to get the tickets when I release them and to get that guide immediately, just sign up anywhere over at buildwealthcanada.ca. All right, so that's all. Have a good one. Take care. Bye.
Thanks for listening to the Build Wealth Canada podcast at www.buildwealthcanada.ca.